The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The angst over Fed credibility subsides for now. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Grafeo. We're kicking you off to the closing bell here in the U.S. Let's get a look at how markets are trading on this Jackson Hole day after Chairman Kevin Warsh vowed to keep inflation at that 2% target, or at least trying to get there. We have equity markets reacting not too much, but we do have S&P 500 in the red, down about 0.3%. What's really getting hit here are the small caps, the Russell 2000, that interest rate sensitive part of the equity market, really dragging here, and the focus really on yields. We have a yield curve that is flattening, the 230s yield curve now narrowing by about 10 basis points as, again, traders amp up their bets for Fed rate hikes, and they're maybe not as concerned about what's going on in the longer end. Finally, the dollar also moving up here on this idea that rates are going to be higher for longer, at least in that shorter end of the curve.
Market set up here into the close. Remember, prior to today, there was a chorus of investors out there who were really urging Chair Kevin Warsh to express a strong determination to fight inflation. And it appears that Warsh got the Jeffrey Rush Colin Firth treatment and did finally find a way to stop stammering and give the markets exactly what they want. And that was an unwavering commitment to curb price growth and a full-throated endorsement of interest rates as the Fed's predominant tool.
We should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Achieving both sides of our mandate over the medium term is not an either-or proposition. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep.
And just about a minute of a 30-minute speech, a wide-ranging speech that was parsed for every single word, and the published statement itself parsed for every single punctuation mark, like his repeated use of ellipses. But there was also a focus on what he didn't say. No explanation of what his reaction function would be for him to actually push for a change in the Fed funds rate, and no explanation as to why he's so concerned about 65 straight months of above target inflation, but didn't push for a hike at the last FOMC meeting in July. Nevertheless, the Fed has decided Warsh's speech is done, and policymakers at Jackson Hole now retreat behind closed doors for the rest of their meeting, and so the market must make of it what it will. For today, it's a rebasement of that debasement trade, with the dollar higher, Bitcoin lower, gold facing its biggest one-day drop in a month and a half. And then there's that flattening yield curve. Take a look. Short-term rates outpacing long-term rates by 17 basis points today, the widest one-day divergence since February of 2025. Let's kick things off to the close here on this Friday afternoon, Jackson Hole Day, with Aron Levine, president of BMO US. And Aron, I do want to kind of start with, I guess, not so much what he said, but just the idea of laying out a roadmap for investors without necessarily tipping his hand. He was very clear. I think, one of the first words out of his mouth was, this ain't forward guidance, although I'm sure we'll all take it as such. But how do you kind of rank what he said today, and does it give you a clearer picture of how the Fed will operate under Warsh going forward?
Yeah, well, thanks, and thanks for having me on again. Look, I think it's always important when you think about rates. It's very difficult to predict the future. Certainty is always better. And obviously, he is working towards giving the market more certainty on a direction and a path. And for us, that's always critical. But what our clients look for from us is, under a variety of scenarios, how do they think about each scenario and how are they prepared both on a short-term basis and a longer-term basis. So for us, it really isn't so much of what's going to happen in any specific scenario. It's working with our clients and making sure they're prepared for a variety of scenarios.
Well, let's talk about your clients. I mean, because you kind of serve America to a certain extent, or serve the economy, I should say, with regards to the businesses and consumers that sort of come to you. Have you seen any, I mean, prior to today, just heading into this second half of the year, have you seen any material change in the way that they're deploying capital, delaying capital spending, shortening loan maturities, anything like that?
Yeah, the good news is there's general optimism. I think there is a level of uncertainty, but that level of uncertainty has been there now for a bit of a while, maybe 12 months, 18 months. And so our clients have started to learn how to kind of live within that uncertainty and not let that prevent them from moving forward. And so they're coming to us and saying, we would love some advice on how to think about it, but we do want to grow. We want to work towards our objectives. And they're looking for capital and they're looking for advice. And so I'd say all things considered, the economy is showing some strength and our clients are showing some optimism.
Can that optimism continue, though, if rates do move materially higher from here?
Yeah, look, anytime rates change, it affects a lot of things. But again, what's great is our clients and what we're hearing and seeing across industries is a lot of preparation and a lot of focus on efficiency and clients really thinking through what happens if rates go up? How do I react to that? Mm-hmm. And the more time being spent now thinking through those various scenarios, the less it'll impact them and they'll have a real plan to move forward. And that's really what we're hearing and seeing.
What was your kind of broader reaction then to the speech, listening to Kevin Warsh? Again, this is a Fed chair that has said that they don't want to communicate as much, but to his defense, I mean, it was like a 30-minute speech. Were you able to read the tea leaves? Does it feel like this is a Fed that's communicating less?
Yeah, I'm definitely not the right person to read tea leaves on the Fed. I'll leave that to others who can do that. What I'm focused on is, and what my team is focused on working with clients, is really thinking through what are the potential impacts of different scenarios. How do we make sure they're prepared as they look at their liquidity, as they look at their risk management? How do they think about long-term strategic thinking? And that's really how we add value, and that's why our clients are coming to us. And as you saw, we had a really terrific third quarter performance, and I think that reflects the advice and guidance we're giving across different potential scenarios.
Well, that's what I'm curious about. You did have a great quarter. I mean, net interest income was up like 6%. I think 4% net interest margin, commercial loans up 4% sequentially as well. That's all good here. If we are headed towards a rate environment where rates are higher in that fight to inflation, does that become a margin benefit, or are you more concerned maybe about the hit that would have to credit demand?
Yeah. Right now, we're excited to see the loan growth that we're showing. And look, our margins are up 20 basis points year over year as we continue to optimize our portfolios and work with our clients. For us, we think there's a lot of momentum, and our clients are looking to grow. They're looking for capital. And so I see the opportunity still to be very strong as we go forward here.
So as we talk about the various sectors of this economy, and specifically, obviously, the ones that fall under your purview at BMO US here, when we talk about small business, commercial business, real estate, housing, agricultural, et cetera, I know they're all different industries, but is there some sort of thread right now that you're seeing that sort of binds them all to the same future, for lack of a better phrase?
Yeah, well, I think one thread is this sort of focus on efficiency, whether it's leveraging AI or just really looking at process and expense. And all of our clients are really thinking through that in a way that, in a disciplined way. But for us, we're seeing growth across a lot of different sectors. We saw growth in our commercial real estate area, our asset-based area, our dealer finance, in engineering and construction, and then our core M&I, and even into our emerging middle market. So we're really seeing good, consistent growth where clients are saying, we understand the uncertainty, we understand some of these different potential scenarios, but we are thinking through how do we grow and how do we make sure we're successful regardless of the outcome.
How much of that growth is coming from AI, whether it's in credit markets, in equity markets, versus BMO maybe looking to diversify and offer clients something outside of the AI trade?
Yeah, look, obviously broadly for the economy, there is a lot of growth tied to AI. But for us, our kind of focus in the Midwest and has been a core. So we work with clients across a lot of industries that aren't necessarily as directly tied to AI. Certainly as we've grown in California with the acquisition that we made of Bank of the West, we start seeing some of those more technology-related sectors. But broadly, we see growth from beyond just the AI play.
I do just want to kind of go back, though, too, and I don't want to keep harping on every single word that Warsh said, but there was also a lot of talk in his speech about this idea of money mattering, his words, not mine. And it seemed to be getting at this idea about the velocity of money, but more importantly, the folks who feed that money into the system, which is you and your peers when it comes to the money that's created out of these banks. So if we have stronger commercial loan growth now, do you sort of look at an inflation fight as being a function of that, complementary to that, or working against that?
Well, I think the good news is the banking industry as a whole is very well capitalized. Companies and banks like BMO, we're in a very good position to be able to support our clients. And so right now we have the capability and the capacity to deliver the capital, whether it's for smaller businesses all the way up to our largest corporate clients. So, banks in general, and certainly a bank like BMO, has more than enough capital to provide and to help fund future growth.
As we sort of, head into whatever the wild blue yonder has, I mean, we're talking about economy, at least on paper, that seems to be holding up. Inflation high, but not necessarily out of control, and now a Fed chair who seems to be clear that he's willing to commit to that. Emily just mentioned the AI boom, a big driver of our economy. As you look for new opportunities heading into next year, does that become a repeat of the playbook for 2026, or are you now looking to something different?
Yeah, for us, we are focused on working with our clients across a range of opportunities. Certainly we deliver on loans and banking, but also critically important is our ability to help them with their liquidity and cash management. Very excited that our treasury business grew 15% year over year on top of a 23% growth the year before that. Certainly capital markets, our middle market M&A business has some of the largest pipelines that we've ever seen. So I think the key and how we add value for our clients is delivering across a range of things. And that can then extend into wealth management and certainly on the consumer side, making sure we're there and working with clients at every level so they get what they need from core banking to mortgages to credit cards. So there's a huge opportunity for us, not only in the Midwest, but out in the West Coast where we've grown to deliver for clients across a range of solutions, and that's what we're focused on.
Aron, always appreciate it. Aron Levine, president of BMO US, kicking us off to the close here on this Friday afternoon. We're going to get a little bit more of a direct reaction from an investor in equity and bond markets. We're also going to go back out to Jackson Hole because our coverage has not concluded. We're going to have a sit down later today with the IMF Managing Director, Kristalina Georgieva, who's actually attending her very first Jackson Hole Economic Symposium. We'll also get her reaction to the speech from a little bit earlier. Stick with us. This is Bloomberg. Welcome back to The Close, live from our studios in New York City, but all the action right now is happening out in Jackson Hole, Wyoming. That's where Bloomberg surveillance co-host Lisa Abramowitz has been staked out all day long. She obviously had a sideline view to that keynote speech by Kevin Warsh earlier today, but you've also had a lot of interviews, Lisa, and you had one that actually occurred prior to Kevin Warsh's statement, and that was with Beth Hammack, and she was pretty direct in about this idea that it's kind of time for the central bank to now start raising rates, fight inflation. Kevin Warsh seemed to tip his hand that he is just as committed to that fight as she is. But I guess the question I have for you is, when does that start? Is that going to start in 2 weeks at the September meeting?
Right now, a lot of people think that Fed Chair Kevin Warsh has essentially not locked himself in for a September rate hike, but clearly put that back on the table in a way that it wasn't prior to 10 a.m. Eastern today. Ultimately, people are saying 65 months of above target inflation at a time where he is looking at core PCE clearly from what his speech delivered, talking about how actually the components underneath PCE were broad-based, not just having to do with oil or tariffs or AI. Gives the sense that there is a lack of patience and that he is ready to deliver along with a lot of the committee. Look, Beth Hammack has been hawkish for a while. The Cleveland Fed president has come out and said that people in her district are asking her to do something about inflation, that they are feeling it bite into their budgets and that it's really becoming an increasing problem. I heard that from others as well on the sidelines here. It seems like people are saying it is not enough to have an excuse of where the inflation is coming from. The absolute price level has gotten incredibly concerning. that has been my takeaway, is that ultimately this is a Kevin Warsh that came out a lot more hawkish than some people were expecting. He did deliver something. It was not a saying nothing kind of speech. He delivered a sense that he was concerned and he was prepared to take action. And that, frankly, is the tone heading into the weekend. And it's clearly what you're seeing bleed out through markets.
Yeah, Lisa, what was the reaction of the investors that you spoke to in Jackson Hole? Because we're seeing the market reaction right now. It's a yield curve that's flattening. It's equities that are selling off. But what were people saying about Warsh's speech?
What I thought was interesting that Kate Moore, CIO of Citi Wealth, was on with us earlier, and she said, actually, markets are taking this in stride. This isn't a market that's going to blink or seriously sell off in response to higher interest rates. If anything, markets are higher in general, and rates are higher for the same reason, which is growth is strong and earnings have been robust. We saw that again and again. NVIDIA just sort of nailing that point home, but it's not just NVIDIA. A lot of people saying you can see the productivity, even if the benchmark numbers don't highlight it. You're seeing it in margin expansion in the rest of the forgotten 493 that have not been forgotten this year within the S&P 500, clearly in the Russell 2000. So even though today you're seeing the sort of knee-jerk, what's rate sensitive, let's sell, you haven't seen that over the past couple of months when actually the Russell 2000 has gained more, has outperformed, even in the face of already people baking in the prospect of higher interest rates. So ultimately, people taking this in stride, saying that this is an economy that can handle it. The real question is this a government that can handle that? And that's what I'm curious to hear from IMF Managing Director Kristalina Georgieva. At what point does the fiscal overhang become the real problem and something that governments have to deal with? Yeah. Not necessarily a central banking problem where you have inflation running too hot for too long and then looking to step in.
All right, Lisa, we're going to check back in with you in just about an hour's time. Of course, the U.S. rate story, international story. Kristalina Georgieva there, the managing director of the IMF, will be joining Lisa out there in Jackson Hole. Meanwhile, back here in New York, when we come back, we're going to assess some of the risks that investors are now having to confront. We're going to catch up with Andrew Slimmon, senior portfolio manager at Morgan Stanley Investment Management. That's coming up next here on The Close, right here on Bloomberg. Surprisingly, we learned a lot today out of the Fed Chair, Kevin Warsh. One interesting comment that he made was this so-called Hall of Mirrors problem, as he referred to it, where the markets sort of rely materially on the Fed's guidance and the Fed relies on market prices. He's basically saying we're all more likely to be blinded to new developments. It's an interesting turn here, and quite frankly, it allows the market to maybe get a better sense of exactly not just how Kevin Warsh thinks, but exactly how this Fed will be guided. Andrew Slimmon, he's senior portfolio manager at Morgan Stanley Investment Management. I'm sure you were listening to this speech. We all were. And it gets to this idea, Andrew, do you walk away from this, certainly vis-a-vis what we had on July 29th at the last Fed meeting, do you walk away from today, here on this August 28th, feeling more confident about at least having an idea of where the Fed might go next?
Yeah, I mean, I think he reiterated and went into more detail of what he laid out earlier, which is the Fed's not going to be as communicative. Hall of Mirrors simply says they're not going to lead the market, and I think he's been very consistent. I think it's very healthy. I'm happy with what he said, but I'm not shocked. Anything he said, I think it's very consistent with what we heard before, just more detail.
And now that you have that detail, I mean, how do you sort of adjust, if at all, any of your sort of investment strategies or allocations, presuming, as most people seem to be doing right now, that the next move in rates is higher?
Well, look, I think even if they don't raise rates, the threat that they could raise rates is causing a change in the leadership in the market today. Now, the market's flat or down a little bit, but if you look under the hood, what you see is that real speculative stocks are not doing well. Well, why is that? Well, speculative stocks work if you know the Fed's going to cut rates. They did very well after last year's Jackson Hole event when Jerome Powell said we're cutting rates. They don't do well in a rate-raising environment. They are selling off. Money is moving into the more stable, larger mega cap tech stocks that are less vulnerable if, in fact, rates move higher. Financials great for financials. He's saying rates will stay high. So I think there is leadership change. And then I guess the other thing that I would say is, if you're hoping for PE expansion, that's not going to happen. I think what he also said, the economy is very strong. And, I think earnings can drive this stock market to higher levels by year end, but don't expect any PE expansion.
Okay, so speculative stocks not working, small caps not working. This is just then reiterating the play that's been really driving the market for so long, as you said, right? Large cap, mega cap, tech stocks. That's just where you want to concentrate the portfolio going forward.
Well, I mean, yeah, but not really from last summer until when Chairman Warsh took over. What worked was the more speculative stuff. The big Mag 7 lagged. And I think it is because if I spoon feed you, right, that I'm going to cut rates. Rates are dropping. Then the inevitable conclusion is go out and take a lot of risk. No need to have risk control. So as, an active manager who overlays trying to control the amount of risk we take, that's coming back into vogue. I don't think it's necessary if they lay out a path, which they did before, of lower rates.
I do want to ask about the other kind of big event that circled this week, and that, of course, was NVIDIA and really just the broader conversation around the AI trade. If you believe what we saw from NVIDIA, that's still intact, the spending's still there, and Jensen Huang expects that spending to at least be strong, at least through 2028. Do you look at the valuations on some of these stocks, the hyperscalers, the picks and shovel companies, even the software makers, and say to yourself, this is still a buy through 2028?
The market, these stocks traded, Romain, they trade a very reasonable valuation. So the market is saying we don't believe in the duration of this trade the way that these companies are articulating to us. So that is the decision that as an investor you have to, make. Is the duration going? Why are the memory stocks at single digits? The market is telling you this could be peak earnings. I don't think so. I think this is going to last longer, but that's the key decision that you have to make. And so when you hear earnings reports where CEOs like yesterday come out and say we see very good visibility out for the next couple of years, I think that strengthens that issue. I do think, though, that this election coming up this fall is going to weigh on the data center build out because it's going to bring into question the duration, whether that's going to stall out.
All right, Andrew. Yeah, definitely so. We'll catch up again next month as we're pretty much closing out August here. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. When we come back, a broader discussion about AI in the classroom.
I think the most important thing in education is the productive struggle. And if you offload that productive struggle to an AI, it's not a great learning experience. And so what I'm seeing is that educators, first and foremost, the educators need to be educated in how to use AI. And then the appropriateness per assignment. This assignment, you can have AI do some ideation with you. This one, you can use it to correct your work. In this case, you shouldn't use AI at all. We have to teach both the teachers as well as the students when there's productive struggle and when there's not.
That was McGraw-Hill CEO Philip Moyer on our show earlier this week discussing AI's influence on education. And our next guest is promoting now AI-ready campuses, AI in the classroom, and pledging to train more than 1 million more people in the U.S. in AI digital skills over the next 4 years. Joining us right now is the president of Cisco and the chief product officer, Jeetu Patel. Jeetu, great to have you here on the program. First, let's start off with exactly what AI actually means, meaning AI in the classroom, I should say, actually means. So when we talk about that, what is the argument for making this a bigger component of learning?
One of the things that if you take a step back and say, what is happening with AI right now, the big shift that's going to happen in society over time is for the past few hundred years, we've always been kind of optimized for how much knowledge do we have. And knowledge is going to get to be a commodity. And actually, what's not going to be something that differentiates people is how much knowledge you have in your head, but more the quality of questions you can ask so you can get any information back and any insight back. And so it's a fundamental structural shift in the mental model that you have to approach education with, which is truly understanding the quality of questions that can be asked so that you can get exactly what you want back, to have original insights that can then be generated to go out and do things that you couldn't do before.
But I'm curious about that statement, though, Jeetu. I mean, that almost seems to be making an argument for more of a human element in our classrooms. I mean, it's basically, you just basically describe the humanities.
Yeah, I actually don't think AI and the human element are mutually opposed to each other. In fact, I think you need both. But that actually tells you even more that you need to have AI in the classroom so that people can actually start to think in very different ways than the way that they've been conditioned to think over the course of the past several hundred years.
Can I just, sorry, but on that point, though, and I understand what you're saying, though, but if the idea is that the knowledge itself becomes commoditized, though, but isn't the knowledge itself, to a certain extent, the foundation of that human critical thinking interpretation itself? You can't really have one without the other, or can you?
It's just the ability to acquire knowledge. You don't have to keep it all in your head. You don't have to retain it all in your head. What you'll be able to do is get a far broader amount of knowledge that can be made available to you. But the quality of questions will determine the kind of knowledge that gets made available to you. So if you know how to ask the right questions, you'll have a very different outcome than if you don't know how to ask the right questions. And so that's the thing that you have to start teaching students about. It's actually not that different from leadership. When the higher up you go within leadership, the quality of questions you ask your teams is far more important than the fact that you have all the answers. You're never going to have all the answers, but the quality of questions determine what your success rate is going to be over time.
So what does this look like in practice? Is this really about teaching students how to prompt language models?
It's about making sure that, Emily, the students know how to take, every individual is going to be a manager of agents. We're going to have agents at our disposal, and we need to make sure that we can figure out a way to best utilize those agents to do work on our behalf. And so that's the fundamental shift that has to be made. And so if we can teach students from a very early age to be AI native and know that you're going to have all of these resources at your disposal, but the way in which you go out and deploy those resources is what's going to be the difference maker. That's a very different skill to learn than the way that we've been teaching for a while. Now, that would tell you that there's no harm in having agents assist a human in going out and getting to a certain level of insight, which is not something that we've taught before. In fact, even open book exams up until now only happen in select courses. And so now you're going from these open book exams to AI available to everyone, and you having all of the compute available to you so that you can make sure that you can get the best possible answer to a problem that you're trying to solve. But this notion of problem solving gets to be the central thesis of education moving forward.
Right, yeah, problem solving, critical thinking, obviously, very important things that children need to learn early on. I'm wondering if you think, though, maybe there's a minimum age for when AI shows up in the classroom, or this is something that, even preschoolers, kindergartners should start adapting? Or is there like a certain period of development where you actually want to be completely AI free?
That's a really good question. I have to think about that because I have a 15-year-old daughter, and she got into technology pretty early in her life. But we wanted to make sure that we actually didn't have her only doing that. So there were certain kind of tactile skills that we wanted to make sure that she learned as well. So I think your question is a really good one, which is you might not want to have AI available at 3 years of age or 4 years of age. You might want to make sure that there's certain foundational skills that get taught first. Yeah. And then you get to when AI starts to come into the picture. Okay. My thinking is once you get to 7, 8, 9, you want to make sure that you have that instinct and texture for how AI is going to work, and then just use that as a massive accelerator. But you need to make sure that your first principle foundational skills are in place.
So give me a sense.
I haven't thought about this enough. So like, I reserve the right to change my mind as I think about what age you would actually get into. It's a really good question, Emily.
All right, fair enough, Jeetu. I am curious, though, specifically, though, about Cisco's involvement in this and sort of what the opportunity, the business opportunity is from schools and universities as we start to see more of this technology integrated in some form or another.
Well, so the role that we want to play at Cisco is, I think anytime there's a technology disruption like the one that we're experiencing right now, which is a seismic shift, you will find that there's going to be some jobs that are lost. Virtually every job is going to get refactored, and net new categories of jobs will be created. And so what we need to do is make sure that the percentage of people that might lose their jobs, you want to upskill society as fast as possible so that the suffering is minimized. And we want to make sure that we have the right level of skills that are in demand right now that get effectively trained within multiple different, venues, and we want to make sure that we can help do that. So that's what Cisco has been thinking about. I think one of the things in the tech industry that historically I've never been a big fan of is we take the kind of downside effects of technology as kind of like a matter of fact, like, yeah, that's just the cost of disruption. There'll be some people that lose their jobs, and that is real suffering that happens. So you want to make sure that you can collectively, as a tech community, as a society at large, be involved in upskilling the entire workforce so that they can have the relevant skills for the time and the era that we're living in.
But as you're making this push into there, and this kind of piggybacks off of what Emily was asking about the right age, too. I mean, we've already seen some schools retrench from this, particularly in Chicago, with Chicago Public Schools kind of kicking Gemini out, at least for now. There are a lot of questions by parents about sort of what their children are being exposed to, the data that's being collected, who's actually going to own it. And then, when we hear about, these various breaches and things like that, the idea as to whether the personal information about my child is going to be somehow protected as well and not shared beyond whatever the parents agree to up front.
Yeah, I think like the reservation around, let's make sure that the child is mature enough and has the core foundational principles in place and the core values in place before you start equipping them with an excessive use of technology is a very sound argument. You just want to make sure that you don't wait for so long that they stop, they don't have an instinct for it, and that instinct develops too late.
Yeah.
And so it's a fine balance to be made. Like, you don't need to start someone at 3 years old because they might not have the maturity to go out and even absorb the things that they might get from AI. And then over time, you might not want to wait until you're 21 to do it either, because that might be too late. So there's a fine balance of when you start getting exposed to technology, and that maturity level that you would expect from the kids needs to be there before you can expose them in the right way.
All right, Jeetu, great conversation. We got to get you back. I have a longer one here because it gets into some deep issues. Jeetu Patel there, he is the president and chief product officer over at Cisco. And of course, one of those concerns does revolve around the world of security. And of course, that's actually raised some opportunities for a lot of these cybersecurity companies. Our next guest, he runs SentinelOne, and they recently joined the earnings parade. Joining us right now is the co-founder, chairman, and CEO of SentinelOne, Tomer Weingarten. Tomer, before we get to some of the numbers out of your most recent report, I do kind of want to piggyback on where we left off with Jeetu. And I've seen reports from your own researchers, and I'm going to quote specifically. You say the model is the malware. And this is becoming a big concern, not just for corporations, but as we were just talking with Jeetu, maybe for schools and parents. The AI rollout is going fast and furious, Tomer, but I don't really know who's protecting us right now.
Yeah, that's a great question, and I think it's twofold. One is the safety of these models themselves. I mean, we just talked about putting these things in classrooms. Do we really know exactly how the model works? Do we have, all the patterns of behavior identified? Do we know how it affects, our neurological evolution. I think we don't really have the answers to all of those. And then on top of that, we're seeing malicious usage of these models. Obviously, these models don't really think for themselves. They're waiting for these prompts, for these instructions from humans, and humans can use them for whatever purpose they choose. And we're seeing, obviously, cybercrime groups, we're seeing nation-state adversaries, they're misusing these models to scale their attacks and go after our critical infrastructure. The underbelly of our entire digital realm is now infused with decades-old infrastructure and software that's just not up to par with the model usage and the capabilities of some of these models.
Well, based on what you're actually seeing, Tomer, I mean, give me a sense. Are the chief information officers out there, are they actually getting sort of these incremental budgets for AI security? I mean, we know the money's there if you want to build a data center or you want to build out the infrastructure, but is there money being allotted for the security?
Absolutely. I think we're definitely seeing more demand. We're seeing more, of these budgets directed specifically to secure AI as folks adopt AI. But at the same time, I think what's really interesting is that there is no set model as to how you do AI security. And right now, there's also not a bulletproof solution. Maybe there never will be a bulletproof solution. So the idea that we can just use this technology inherently safely, I think is a bit misguided. I think we're leaning on, frontier labs to make sure that they put enough safeguards into their models. And typically they do, and they do the best they can to achieve that. But you also have open source models. And in the case of open source models, you can really strip out any type of safeguard and use them for whatever you want. So we're entering this very interesting period of time where the defense and how you defend from some of these attacks is not entirely clear. That's where, vendors like SentinelOne come in with new capabilities that are designed to always monitor what these models are doing, essentially trying to continuously vet the behavior of the model without making any assumptions that it's going to do something good or bad. But the models on how you secure this are just not set yet. So it's all being built as customers are starting to adopt AI more profoundly in their environments.
How then do you differentiate yourself from all the other competition out there in the cybersecurity space when you're trying to basically get more customers and convince them that they should go with SentinelOne?
I think our approach, has been there for about a decade now, and it's even more true today. We believe in autonomous cybersecurity. We believe that the speed in which attacks move and the scale of what we see, the volume of attacks, really necessitates a complete autonomous software that can detect and protect in real time and remediate any damage that has been made. We're one of the only vendors in the world today that can actually supply that in any given environment, in public cloud, in regulated environments, in air-gapped environments, federally, but also for schools. So it's an amazing piece of software that runs completely autonomously, scales the defenders in doing their job from protecting from this onslaught of attacks. So all in all, we are big believers that the next stage in cybersecurity is going to be waged with autonomous security, not with necessarily just more people, more consultants, more hands on keyboard, but with software that can actually scale what they do and allow them to be more productive.
Your second quarter results, annual recurring revenue, $1.22 billion. That was beating estimates. Adjusted EPS beat for the second quarter, revenue beat. What's going to keep the momentum going? What's really going to drive growth going forward?
Yeah, I mean, in many ways, our emerging solution sets have accelerated in this past quarter and even in the quarter before. We're at this very, very interesting juncture that sits there and really provides the fabric for all of your cybersecurity operations. And on top of that, when we think about where models and agents actually run, they run on machines, on workloads, on endpoints. And that's exactly what SentinelOne is doing. SentinelOne has designed a system to protect workloads, endpoints, and the humans using them from exactly these types of attacks. And that's where we see just an immense amount of growth. There's also a huge market in endpoint protection that is still in the hands, at least 50% of it, of incumbent solutions. And these incumbent solutions, these legacy solutions, are just not able to keep up with attacks. So we're seeing a lot of folks now starting to migrate away from these incumbent solutions and into modern endpoint protection solutions.
So give me a sense, though. I mean, as this built out, I mean, I have to ask you, I mean, we all know, I mean, the bigger players out there, the Googles, Microsofts, Palo Alto Networks are all assembling broad security platforms as well. Why does a customer come to SentinelOne as opposed to going to those other names?
I think it's first and foremost efficacy, and it's the autonomous nature of the platform. There aren't many platforms out there that are actually completely holistic and can work out of the box with no lengthy integration or consultancy work. If you think about somebody like Palo Alto Networks, great company, but they have about 7 or 8 different platforms that you need to put together to even get to the point that you're starting to get the right visibility into your environment. I think that complexity alone actually leaves more gaps for attackers to go after. So for our customer set, and we secure some of the most discerning organizations in the world today, some of the biggest companies, half of the Fortune 10, clearly they look at the efficacy of our product, of our cybersecurity platform, is something that can be deployed and immediately detect and protect in real time without that human intervention.
Tomer, really appreciate it. Got to leave it there. Tomer Weingarten, the SentinelOne Co-Founder, Chairman, and CEO. And on this topic, we should point out that OpenAI, one of the biggest LLM companies out there, released an open letter yesterday called a collective action on cyber defense. The ChatGPT operator joining with 127 other companies, including Anthropic, issuing that call to action. One of the signatories on that letter was Oliver Wyman. We had a chance to catch up with the CEO, the relatively new CEO of Oliver Wyman and Warsh Consulting, Ted Moynihan, to talk about this. Take a listen.
We thought this was really timely. We think it needs to be called out that the speed of development of AI means that the risks, in particular the cyber risks, but other risks are amplifying very, very quickly. And the letter does a really good job of calling that out and also making the point that this is a collective action problem.
Is that something, though, that you had been seeing in your role at Oliver Wyman and at Warsh? I mean, you've been advising CEOs now and other companies for, decades. Were you already seeing evidence of this concern out there amongst some of those folks in the C-suite?
Yeah, absolutely. What we see is, companies in multiple industries, but also governments, technology companies, AI companies, all feeling that this is a rapidly growing problem, which and I'm from Ireland. We have a saying there that it takes a village to solve a hard problem. This is just that kind of problem that no individual company can solve it alone, and it requires the whole system to work together and really to raise the focus on this.
I am curious, though, too, about this idea. This letter comes at a time when obviously everyone's focused on the Hugging Face breach, which involved OpenAI's tools sort of going off the reservation, if you will. And I mean, there's a lot of issues right now about who we should trust. And by the we, I mean the royal we, the public writ large. Do we put our stock that the corporations and other folks that signed off on this letter, including OpenAI itself, are the ones that can actually be the gatekeepers or the sentinels, if you will, to protect us?
Yeah, look, I think it's a great question, Romain. I think, AI has been built by technologists and technology companies, but, trust relies on all of us to build trust in the systems that we operate, in the industries that we're building, in the economies that we're in. So I think this is, something that, really relies on the action of all of us. I do think the letter calls out that AI companies, need to act as well, need to create frameworks that are shared with industry, particularly shared with the more vulnerable parts of our industries, critical infrastructure, hospitals, and so on, and that there is a responsibility on AI companies, technology companies, cyber companies, as well as industry, as well as government. So I welcome that being called out.
Are we moving too fast? I mean, is there, with regards to you being part of this letter, is there some sense here that folks are actually calling for some sort of slowdown of the deployment and development of some of these AI models?
You know, I always say to people that where we are right now, you know, in the AI kind of transformation that we're going through is kind of in the messy middle. You know, we had a few years there where people were just getting to grips with the technology and what it was able to do and rolling out pilots and experimenting. And now we're, you know, what we see in our work is we're in a phase where, you know, people are really trying to scale innovation and scale transformation and, you know, enable their whole organizations. And that's messy, you know, and that's going to be, you know, happening over the next few years. And, you know, in that environment, you know, it does require a sense of confidence and clarity and security to make the next waves of investment, you know, from the board through the CEO, through the organization. So I think to make the next step now, that is what is required: security, clarity, confidence, and trust. And that is why I think this is a really important, you know, issue right now.
And our thanks to Ted Moynihan, CEO at Oliver Wyman. Now let's take a look at how markets are right now as we march closer to the closing bell to close out the day and to close out the week on this Jackson Hole day. We do have equities selling off. Most of the movement coming out of the small caps, those interest rate sensitive parts of the market. You can see the Russell 2000 and flat. That is the term here to describe what the yield curve is doing. It's flattening as those shorter dated treasuries really move up higher in rates here. The 2-year yield up about 12 basis points as traders kind of parse through. Yeah. We're going to be seeing rate hikes potentially in September, Romain, and that's lifting the dollar as well.
Let's bring Steve Sosnick into the conversation, chief strategist over at Interactive Brokers. So, I mean, I'll put you on the spot there. You answer that question. I mean, that Fed meeting is what? Less than 3 weeks away. Are we going to get a rate hike then?
I don't think so.
Yeah.
I've been in the December camp for a while, and it's not necessarily for economic reasons. It's for political reasons. Thinking about how Warsh got the job and who had to appoint him to the job, we know that the president is strongly in favor of cutting interest rates. I think Warsh realizes that's a non-starter, as does pretty much everybody in the markets. But I think he does not want to go out of his way to antagonize the president by raising rates before the midterms. I just think unless there's some catastrophic print, I think as long as we can muddle around where we've been muddling around, we're going to get tough talk out of the Fed, but not a lot of action. But that's problematic.
But that raises the credibility question. We've got 2 meetings before the midterm, September and late October. As he pointed out in his own speech, 65 months now where that 2% target. We've been above that 2% Fed target. Beth Hammack was on with Lisa Abramovich earlier today. I know she's always been a hawk, but she was very clear. It's time to act. What are we waiting for?
That's a question more for Warsh than for anyone else. That's where I kind of.
Let me rephrase that. Go ahead.
Yeah, I mean, we went up from like a 35 to a 60% probability for September. To me, October is off. You know, it's I think 90% probability for October. That to me is off the table. I can't see them doing anything, barring like something truly catastrophic, literally the week before the midterms.
What's the power, though, potentially, message-wise, of just a 25 basis point hike? And I ask that because that's not going to derail the economy. It's not going to derail the market. But it would send a signal that, that's sort of backing up your action, right? Your words. I mean,
in a non-political world, you are 100% right. 25 basis points isn't going to do anything. I believe it was Beth Hammack this morning who said, that financial conditions are as easy as they come. It was one of the people on air this morning. And I don't disagree with her. You look at the Bloomberg liquidity indices; they're all screaming. I think the long end is being hit by liquidity problems because I think everybody's recognizing that not only are the world's central banks needing liquidity, but so are the cash flow generating companies that had been providing liquidity for so long. That's part of it. But I think that's the problem. I think I think it's smarter economically for him to act now, get that off the table. We're active, we're moving. I don't know that there's the political will to do that, and that's, I think, why we're at 60, not 99 or something like that.
Do equity traders care about the credibility of the Fed? I mean, why is it important?
They should. They don't necessarily. I mean, I think, Emily, that's why we're only down 20 points on the SPOOs as opposed to down more significantly with 12 basis points on the short end.
Right.
my initial reaction was like, gentlemen, you may feel free to resume your regularly scheduled rally, because what was the first thing that stocks did? So you're ready when Warsh left the podium, rates were already 7 or 8 basis points higher at the short end. Stocks rallied because it's a Friday, it's a quiet day, don't short adult tape, all that kind of stuff. So off we went without actually any regard to it. Then finally the weight of money kind of made people step back and think. But stock traders, as long as they could justify them with decent earnings, and obviously yesterday NVIDIA went a long way to that, and there was a huge rotation. I can't remember a day where you had a fairly significant, decent-sized rally, and yet one sector only up in the S&P 500.
IT.
That was it.
Right.
10 down, 1 up, and 200 S&P 500 stocks lower, up more than advancers. So it was a weird day, and I think we're sort of seeing the hangover of that. But it shows you that if the right companies do the right things, the stock market can just sort of carry on.
Carry on. Okay, so that's what's going to carry us then until we finally get maybe a little bit more clarity from the Fed. Just carry on. Keep buying NVIDIA, because some of these chips are selling off.
I think I'm not a huge seasonalities person. I think that but I do think it behooves us to think about September a little bit differently, because we've got one of two things happening. Either we are going to get our first rate cut, at least this, now it's better than a coin flip that we might. Although I'm not in that camp. Yeah. But also you have just the seasonality. We have seen situations where the stocks sort of peter out, and you see it today with NVIDIA, where it's under a bit of profit taking. To me, what happened yesterday was, for the kind of rallies we saw, particularly in the software companies and in NVIDIA, you had to have institutional money flowing in, and that institutional money is just sort of washing in, washing out, and it's like we can't be momentum traders to that degree all the time.
Yeah. All right, Steve, got to leave it there. Steve Sosnick, Chief Strategist over at Interactive Brokers. NVIDIA shares down 5% after yesterday's 9% gain. All of the major indices in the red on the day, but still higher on the week and for the month of August. A full breakdown of all of today's price action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Emily Grafeo, taking you through to that closing bell with the global simulcast. We're joined now by Tim Stenovec, Lisa Mateo in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, and a market that has clearly made it clear what it thought of that big speech by Kevin Warsh earlier today.
I mean, I don't want to steal your thunder, Romaine.
Yeah.
But the bond market reaction, especially at the front end, 2-year yields up 12 basis points right now.
Yeah.
A straight move higher, basically starting at 10 a.m.
Yeah, you got to throw it out there. And you talk about that big jump that you're seeing on the short end of the curve. There's no activity really on the long end of the curve. The 30-year yield up about 2 basis points. And that's the story, a flattening of the yield curve and anticipation that the next move by the Fed will be to hike rates, and probably sooner than later.
And there is a read-through into the equity market. When you look at the Russell 2000, those small caps, those interest rate sensitive stocks are selling off the most today by a pretty big divergence than the S&P 500.
Yeah, the one thing I wanted to point it out, which we haven't actually spoken about so far, but the Bloomberg Dollar Spot Index, that's up by about 0.3% right now. So we're watching the dollar closely, too, after all this news we've had today.
Yeah, and particularly we have so much talk about that debasement trade coming out of Treasury Secretary Besson and the moves that he started telegraphing about 2 weeks ago. That bid into gold, that drop in the dollar being reversed for today. Of course, a lot of questions right now as a lot of people sort of, I guess, maybe depart for the next week or so until after the Labor Day holiday and sort of what that means. Remember, if you have your calendar out, you want to mark down September 16th. That is the next Fed decision day. October 28th is the next one after that. Election day is November 3rd here in the U.S., and then the final Fed meeting on December 9th of this year. We have red across the screen here in the U.S. for U.S. equity markets, so the losses are relatively fractional. The Dow Jones Industrial Average only down 10 points. We'll just basically call it unchanged. The S&P down 20 or 0.25%. The NASDAQ down 139 points or 0.5%. The NASDAQ 100 down 0.7%. And the Russell 2000 taking the biggest brunt of today's sell-off, down about 1.4%.
Romaine, you're not leaving us next week, are you?
Yeah.
Oh.
Yeah, man.
Oh, really?
Yeah.
You're gone?
Who allowed that?
Sorry.
I don't know.
It's been great working here.
Okay.
Yeah.
All right. Well, we'll see. We'll see who shows up on Monday. As far as the S&P 500 looks today, we did see 230 stocks move higher. We did see 272 stocks move lower.
And if you take a look at the IMAP, it's a different story than yesterday. Yesterday, remember, there was only one sector in the green, and it was tech. More of a mixed bag today, though. What's leading the way? Consumer discretionary, communication services, energy, staples. And what is the laggard? It's IT. Some days you're up, some days you are down. And it's all after that Fed meeting.
All right, well, let's get to some of the stocks that moved higher today. Gainers, how about that? Look at this. We got Gap higher today by close to 13%. Shares jumped after the company named Michael Francis to head up its Old Navy brand. Profit, too, outpaced estimates. It offset a sales decline at Old Navy and lower sales guidance. Francis will take over as CEO of Old Navy on November 2nd, and the current CEO will transition to an advisory role. It does follow a sales decline last quarter at Old Navy, and the company trimmed the upper range of its outlook for 2026 net sales. Still, investors cheering the overall results from Gap, higher today by 13%. Also, shares of Affirm, the buy now, pay later fintech company, they were higher today by as much as 17% earlier in the session. A steady move lower, still finishing the day in the green, up 0.4%. The company did hit an intraday high going back to September of 2025, so the highest intraday since then, close to a year. This after the company forecast revenue for the first quarter that beat the average analyst estimate. We did speak with Max Levchin, the company's CEO, and he said that American consumers, at least the consumers that he views, he calls them the Affirm consumers, he says they are healthy right now. And finally, taking a look at some of those sports betting companies. DraftKings and Flutter shares were higher today. Shares of DraftKings up by 4.3%. We did see them move higher midday after after Kalshi faced a setback in a U.S. appeals court. Remember, Kalshi, the prediction market, you can do a lot of what you do when it comes to sports betting on Kalshi, but it's not considered sports betting, at least by legal entities, the CFTC.
It's predicting, right? That's different.
Excuse me?
It's predicting. That's different.
It's predicting.
Yeah.
At least that's what the CFTC says. Yeah. So this is something that is not going away anytime soon. And Kalshi faces this challenge on a state by state basis. Yeah. But this is the latest setback for the company. Flutter shares higher today by 7.1%. These sports books have been pretty beat up, though, as people have moved away from traditional sports books and gone instead to rivals like Polymarket and Kalshi.
All right, I want to get to the decliners since we get on the upside. We want to start with PayPal. Their share down about 12%. And here's the reason why. Sources are saying there's a group from Advent, Stripe. They're not going along with their $50 billion pursuit of the company. So that was a big blow. That was not good news for the company. It would have actually ranked as one of the biggest ever leveraged buyouts if it had gone through. But PayPal, early mover in digital payments, right? But the thing is, a struggling modernization in its payment technologies have been a real problem for the company. Rivals, you have Apple, you have Alphabet. They've kind of seized the market share. And then you have the company. They ousted their CEO earlier this year. They have a new CEO in the spot. And he's saying specific financial goals for the company. He wants to change how it reports earnings, also how they assign each line of business specific revenue target. But the company shares, down about 12%. Another downer, and this was on the upside yesterday. Yeah, we're talking about NVIDIA. Their shares also are down lower. What a difference a day makes. The leader in AI chips coming off a huge rally. This is when it projected sales growth of about 70% for the next fiscal year. The rise yesterday, it added about $442 billion in market value. So we've been talking about different experts on our show. They're saying, why the dip? That's a question we posed to them. They said, you know what, it's not systemic. Maybe it could be interest rate related, but not an issue right now. And lastly, Ulta shares, they are taking a hit as well. They're down about 4%. Higher discounts, premium promotions, they really weighed on their margins. So that was the issue for Ulta.
All right, and we go back to the Treasury market. We were just talking about it a little bit earlier. Obviously, the flattening of the curve, the story of the day, a 12 basis point increase on the 2-year yield, as a lot of traders now price in slightly greater odds that the Fed will start hiking rates this year. Your 30-year yield not going anywhere, and that's a testament maybe to the idea that the Fed will try to get inflation under control.
Hey, Romaine.
Yes, Tim.
How much chicken do you think the average U.S. resident eats per year?
How much? I don't know. 100 pounds.
Yes, 103 pounds.
Wow, look at that.
Wow, he did his homework, I guess.
There's no off position on the Genius.
But here's the important part. It's an increase from 5 years ago, a 6-pound increase from 5 years ago. Red meat consumption is declining. This is according to the Department of Agriculture. We're talking about this because Lisa getting this story on my radar today. It's in the Financial Times. It's about the cult of the $5 rotisserie chicken that is defying inflation, and it's at Costco.
How is that defying inflation? I mean, I know $5 is
$4.99 for a rotisserie chicken?
No, that's not my point. My point is, how are they selling it at $5 and not like going out of business?
They do it all themselves. They have their own slaughterhouse in Nebraska. Yeah.
Oh, okay. I thought you meant like in the back of the store or something.
Well, maybe there's a store there, but yeah, it's bringing it all in house.
Yeah. Have you ever been to, like up to one of those places in Washington Heights, where you can get the live chicken and they do the deed for you right there?
Not on purpose.
Okay. Yeah.
Yeah, not on purpose. What do you got for us?
The Pro Bowl. I know you're a big sports ball fan, Tim Stenovic. Yeah. But the Pro Bowl, it's been an institution since 1951 in the NFL. And earlier this week, they said they're getting rid of it. Nobody watches it, honestly.
Okay.
And the players don't care because they don't want to get hurt. So they don't really. It's basically like, the equivalent of like a backyard touch football game. But they finally decided, end of an era. I don't know if inflation had anything to do with that.
Yeah, they're losing money.
Emily, are you a sports fan?
I'm trying.
Yeah.
The Pro Bowl, they do have a Pro Bowl
what does that mean?
for
Your
the
significant
NFL
other
cheerleaders
forces you to watch it?
as well. Yeah. I follow the cheerleaders, and so the Pro Bowl was always a fun time to see all of the different cheerleaders all coming together.
And her college football. Emily, you follow your college football.
I do follow my college sports a lot. So I do need to graduate. I need to grow up.
Okay.
All right. Well, you got the weekend to do it. Guys, have a great weekend.
You too.
Maybe we'll see Romaine here on Monday. Maybe we'll see Emily.
I'm going to join Carol out in the 7 Seas, wherever she is.
Go ahead. That is going to do it for our cross-platform coverage of the closing bell. Have a good and safe weekend, everybody. We will see you same time, same place on Monday.
Our coverage continues here on Bloomberg Television. We go back out to Jackson Hole for reaction to Kevin Warsh's speech and a sit down with the IMF Managing Director, Kristalina Georgieva. That's coming up next here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romaine Bostic here with a look at how equities finished out the day. Modest losses all around for most of the major indices here in the U.S., though most of the major indices in the U.S. still finishing the week in the green, and all the major indices right now on track to post a monthly gain for the month of August. But the real activity was in the bond market, with the short end of the curve seeing most of the action. Big selling there that pushed yields higher by about 12 basis points. Less activity on the longer end with the 30-year yield. That yield was only up about 2 basis points. That's largely a function of what we learned out of Kevin Warsh and his commitment to actually fight inflation. It's a pivot, and it was really more, I guess, the articulation, if you will, that really did put a bid under some of the financial stocks like Bank of America. It put a bid under a lot of discretionary stocks as well. Remember, they would actually benefit should inflation start to come down. However, of course, that fight against inflation could slow the economy, and that raises questions about some of those longer duration names like NVIDIA, as well as some material names like Alcoa. And that does bring us to our top story for the hour. And it's not so much what's next for the Fed, but really what's next for the economy. The key takeaway from Warsh was that explicit acknowledgement of the inflation problem and explicit language that getting the core inflation growth rate back down to the Fed's 2% target isn't just an idea to pass off to markets. It's a commitment by the FOMC to follow through on its dual mandate.
Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep.
Of course, inflation is just one side of the mandate. Maximum employment, that's the other. And now markets are looking for clues for that balance. Raising rates to fight inflation, sometimes it slows economic activity, which often means a slowdown in job growth, if not full-on contraction in hiring. Now, Warsh didn't say job losses would be harmless or even specify how much unemployment he would tolerate. And that is the asymmetric policy problem here. But the silver lining, of course, is that that employment objective is much closer to being satisfied than the price stability mandate. And maybe that labor market strength is what gives the Fed enough headroom to prioritize around inflation and a 2% target that has remained elusive now for more than 5 years and counting. Dana Peterson joins us right now, chief economist and leader of the Economy Strategy and Finance Center at the Conference Board, who is out there in Jackson Hole, Wyoming. And Dana, I do want to get your reaction to not only just what Warsh said, but the way that he said it. What do you think is going to be the primary focus of this Fed over the next few meetings?
Price stability. He's been saying that repeatedly, and he was very strong on that today. And so I think the Fed is going to continue to keep rates a little bit restrictive, especially since we have these structural drivers of inflation that are leaning against the easing that we're seeing from shelter costs.
So, but it gets to this idea as to sort of when you would actually see action. There are a lot of people that are looking at the next meeting less than 3 weeks away and saying the Fed should just hike rates. Did you get any sense, though, that Warsh is actually prepared to act rather than just talk?
I think definitely he is prepared to act if needed. He did note that we still have some inflation readings coming out, and there's also the uncertainty, certainly given geopolitical risks out there. And I think that the decision is not made yet, or at least he's certainly not going to telegraph it. And I just think that the Fed can probably remain on hold for now, unless we see inflation misbehaving.
What's your view at the Conference Board when it comes to the health of the labor market and how that overlays with what we know about inflation and investors, or I should say rather CEOs' expectations for inflation going forward?
Yes, I'd say the labor market is still pretty healthy. The number of people on non-farm payrolls is extremely elevated. It got to a very elevated point in the end of 2024, was kind of flat over 2025, but in recent months it's been picking up a little bit. The unemployment rate is low because initial jobless claims are low and continuing claims have been low. And certainly we don't see any material inflation in wages, which is also part of the labor market. And so I think we're still in this low fire, low hire stasis in terms of the labor market.
With regards to the inflation side and the amount of spending that we continue to see in this economy, I don't know what the official government data is telling us, but every company, a retail-focused, consumer-focused company that has reported earnings has talked about this idea of a more choiceful consumer. Some going so far to say that these folks are coming in to basically buy what they need and not much else. Are you seeing similar patterns, and does that force the issue for the Fed?
Indeed, that's been the sentiment, or that's been the measure that we've heard among consumers even earlier than now, like late December of last year and into the beginning of this year, where they were definitely leaning towards necessities and away from discretionary items. We're actually seeing that in the data, in the BEA real consumer spending, where people are spending more on things that they need, like food, gasoline, electricity, and moving away from highly discretionary goods and services, even things like cars. And when it comes to entertainment, they're still trading down to streaming from going to the movies, which is much more expensive. So what consumers were signaling earlier this year is definitely showing up in the data now.
Dana, so as this Jackson Hole meeting really gets underway, obviously the public speech is just kind of, for all of us folks out here in the market, he gave the market what they wanted. Now he goes behind closed doors. There's a lot of discussion about the mechanics of the Fed, these task forces, all this other stuff. What's going to be most important for you coming out of these meetings, independent of, just that dual mandate speech today?
Well, I think it's that promise that the Fed as a committee will do what's right for the economy. And should it be the case that inflation does pick up again and it discontinues its deceleration, that they will hike. But again, I think there's plenty of room for them to just remain on hold, especially since we are seeing consumer spending slow, as well as pivoting towards those things that people need. And really, most of the growth in the economy this year has been due to investment in technology, especially AI. And there's no guarantee that's going to persist at the relative strength that we've seen so far. So there's still an argument for just holding and waiting and seeing.
All right, Dana, really appreciate you joining us. Dana Peterson out there in a very rainy Jackson Hole, Wyoming. She is the chief economist, leader of the Economy Strategy and Finance Center over at the Conference Board. When we come back, we're going to focus a little bit more on financial regulation. There's a lot going on in Washington. We're going to catch up with the former SEC Commissioner Mike Piwowar, now running, of course, the Georgetown Passero Center. We're going to have that conversation when we come back after the break, right here on The Close on Bloomberg. All right, as Kevin Warsh and other folks go behind closed doors to discuss monetary policy frameworks, there are debates back in Washington on the lines in American investing and whether they should be redrawn. The SEC considering changes to accredited investor rules, regulators looking to put more private assets into retail funds, market exchanges, experimenting with tokenization, and academics weighing how the latest wave of innovation interacts with it all. Mike Piwowar has been steeped in these debates for decades, from his research years ago on bond pricing transparency to his regulatory role as an SEC commissioner. Now he's the head of Georgetown's Passero Center for Financial Markets and Policy. Mike, great to have you. I do want to start off with Kevin Warsh, because in that speech at Jackson Hole, he talked about the idea that moving interest rates is the predominant tool for the Fed to fulfill its mandate. And he seemed to kind of I guess, I won't say knock, but certainly throw a little bit of shade at this idea of using unconventional mechanisms when times aren't necessarily unconventional. I mean, you were at the Council of Economic Advisors during one of the most unconventional times in our history during the financial crisis here. I am curious to see what you think of that comment, particularly given just a week and a half ago, the Treasury Secretary was making it clear he was ready to use unconventional tactics to keep rates down.
Yeah, Romaine, thanks for having me. Yeah, it's consistent with what Kevin Warsh has said in his nomination hearing and in some of the press conferences that he's had after the FOMC meetings, that he really wants to focus on conventional monetary policy, and he wants to move away from the lines that are blurring into fiscal policy. And he's even gone up to the point where he said earlier that, owning a bunch of long-term bonds on the Fed balance sheet is sort of blurring the lines of fiscal policy. So he's actually looking to shed those from the balance sheet rather than following the Treasury Secretary into intervening in these markets. And he made that very clear today. He reiterated the fact that unfettered, unfiltered market prices are important for the Fed to fulfill its mandate. And he came up with an analogy that Ben Bernanke talked about years ago, where you have, if the Fed is looking to market prices, but the market's looking to Fed guidance, you can end up with what he called a hall of mirrors problem. And so what he wants is unfiltered market prices in the bond markets, and he doesn't want to try to manipulate that and then have markets try to then figure out what the Fed's going after that.
Well, he's going to have to then reconcile that with his colleague at some point, and you're kind of getting at what was obviously a very talked about column by Stan Druckenmiller, kind of admonishing his former protege, and he kind of made the exact same point. I can't remember the exact language, but it was basically like that. One of the purest forms of kind of knowing where things are going is just letting the Treasury market do what it needs to do, and you'll get the message. I know that Warsh seems to be intent on allowing for that. But he also made it clear, too, he doesn't want the market to do the work for the Fed. He thinks the Fed has a responsibility to fight inflation on its own. You think he will do that?
Oh, yes. I mean, he made it very clear. He was, people were looking to, he said he wasn't going to give any forward guidance, and he addressed that right at the beginning. And folks were trying to figure out, the biggest question people asked going into this meeting that I heard was, they said, well, at least give us your reaction function, in the sense that people wanted some insights into what data are you using, and then how are you reacting to that data in terms of your monetary policy. Well, he pretty much answered the first part of the question, and he gave some specific examples of some of the data that he's looking at. And in fact, he spent the first part of his speech saying that he's actually looking at some new data involving the effects of artificial intelligence. For the second part, how he's going to be reacting to that, he didn't give an explicit answer. What he did instead was he laid out some core principles that he's thinking about. Now, one of those core principles, he specifically stated that the 2% inflation target is firm and fixed, and he specifically mentioned the PCE index. There were some questions as to what index he was going to be looking at, and whether the 2% was actually something that he was going to be targeting, or whether he was going to be satisfied with something slightly above 2%. We've been stuck in that 3 to 4% range for a while.
Yeah.
He came down very heavily and said, look, I'm looking at 2%, and basically laid down the line to say, you measure me by my ability to get down to 2%, and I'm going to be holding myself accountable to that.
I do want to get your thoughts. We only have a couple minutes left, Mike, but I mean, given your history, I mean, just about how transparent the markets are to be used as a reliable indicator. I mean, your research back in the day, kind of led us to trace and a lot more transparency in bond markets, and that seemed to be the move. But now with prediction markets, tokenization, all these other sort of financial innovations that come in, there's some concerns that now we're going back to maybe a little bit more opacity in the markets. How do you see it?
Yeah, I mean, there's always been concerns, and any time you get markets where the Federal Reserve has been involved, and you mentioned the extraordinary efforts after the global financial crisis, right? And the Fed had been buying mortgage-backed securities, and so the prices in the mortgage market were artificial for a long time, and now the Fed's getting out of that, and we're starting to see what those exact markets are. In terms of prediction markets, I actually believe there's academic evidence on this, that they're actually providing more transparency and providing more information to folks, not only to retail investors who are investing in it as retail traders as a hobby, but what we're actually seeing is that institutional investors are becoming more and more interested in prediction markets. First, as a way just in terms of price discovery. Yeah. So, for example, if you want to look at, well, what's the probability of the Fed increasing rates by 25 basis points at the September meeting?
Yeah.
The odds on the prediction markets went from about 1 in 3 before today's speech to about 50-50 afterwards, and it matches pretty much what we're seeing in the futures market. Yeah. And so the prediction markets provide an opportunity for all kinds of new event contracts that either match what we already have, or can actually get some new markets, and people will be able to hedge in these markets.
All right, Mike, we got to leave it there. All right, we've been talking all day about that keynote speech by Kevin Warsh out at the Kansas City Fed's Economic Symposium in Jackson Hole, Wyoming. We do want to go back out there where the co-host of Bloomberg Surveillance, Lisa Abramowitz, is still on the ground there, and she's got a special interview, a sit-down with the managing director of the IMF, Kristalina Georgieva. Lisa, take it away.
Thank you. Thank you so much, Romaine. I am here with the IMF Managing Director, Kristalina Georgieva. After a momentous speech from Fed Chair Kevin Warsh, this is your first Jackson Hole Summit. I would love to just first say thank you for joining us. What was your takeaway from Kevin Warsh's speech? What did you think of it?
He did a great job. He articulated his views on the evolution of monetary policy in a rapidly changing world very clearly, and his commitment to price stability, that 2% is a target for the Fed to achieve, was very clear. I think the audience was positively impressed by the clarity and also the message he communicated to the central banking community. We have to be humble. The world is changing so rapidly. We have to carefully watch what is going on and make our best call for the benefits of people, for the benefits of the economy.
You actually had also a speech later in the morning where you wrote, central banks' most critical role is to ensure inflation remains low and stable. How do you understand the past more than 5 years where inflation has been above target? Is this the fault of central bankers? Is this something else that we can address?
What has happened over the last years is shock upon shock upon shock, and that pressed governments to borrow and spend more than they should. And of course, that has some inflationary impact. And also we know that when we were hit by COVID, at that time, the public spending was perhaps a bit more generous. But how do you know how much is enough when the world economy comes to a screeching stop? I would blame central banks only if they don't draw lessons from experience. And what we're seeing here in Jackson Hole and what we heard from Chair Warsh is they are drawing lessons from experience.
And the lesson, at least on its face, seems to be perhaps they need to be a bit more restrictive in their policies. Do you think that more broadly around the world, that needs to be the approach, even though shocks are still going to keep coming? It seems like the shock after shock after shock isn't really changing.
We have to accept this reality that the world is changing very rapidly, and that part of this change is a positive or a negative shock. Right now, we are dealing with two shocks that work in opposite directions. We have the energy supply shock, and then we have AI. One drags growth down, the other one pushes it up. We have to get accustomed to an environment that is less predictable. What do you do in that environment? When first, build your buffers, especially in good times. Right now, the economy is doing well. Well, let's cut the deficit, bring down the debt. And two, recognize that your best friend are sound policies and strong institutions.
Do you ever get frustrated? Do you feel like you're beating your head against the wall when you say, come on, get your house in order, to people who are saying, no thanks, maybe the next guy can come around to do it? Because it seems like no one's listening.
Some are listening. Look at emerging markets. They have done fabulously well. Their monetary policy frameworks are strong. Their fiscal frameworks are much better. Sometimes we look at them, they do better than advanced economies. So some people that have had the painful experience of crisis are listening. It is human nature. When do we fix our roofs? When the sun is shining or when there is rain? So we will continue to shout, police, the sun is shining, it's a good time, bring the roofers.
Bring the roofers. Ken Rogoff, earlier, a Harvard professor, was talking with my colleague Tom Keene, and he said, ultimately, it's going to take a debt crisis to really cause developed markets to get their fiscal house in order. Do you agree?
Not necessarily. We have seen historically that actions have been taken in good economic times. Sound growth, good household spending, investments booming, and then adjustments, fiscal adjustments take place. But we have to recognize that we live in a world of popular desire for the government to spend more. Why? Because the government has done it over the last couple of crises. Did it after COVID, did it after the energy shock from the war in Ukraine, and food shock, price shock at that time. So people are saying, hey, you did it, continue. Not affordable. My message to everybody is delay no longer. Why? Because debt levels are now above where they were after the Second World War. And Ken Rogoff is right to say, do you really want a crisis to get you to do what is necessary? Please act on your own.
It sounds like a kid who's gotten candy after everything that they've done, and suddenly someone's saying, take the candy away. You might get a tantrum, but it is what it is. You said in your speech also that IMF popularly stands for internet. It's mostly fiscal. It's an interesting point at a monetary policy conference. How has the fiscal debt overhang complicated monetary policy and made it a lot more difficult for policymakers to really address inflation just head on?
Well, first, more demand, more spending pushes price levels up, not down. Second, when we have a high level of debt, it is much harder for central banks to act decisively by raising interest rates. Why? Because then the cost of serving the debt is going to go up, and they, especially the Fed here, dual mandate, price stability and employment. We don't want to undermine the strong performance of the economy, and that is why their job is harder. But it is their job. They have, first and foremost, the responsibility for price stability.
Another aspect of this conference has been stablecoin, although if you get people in the hallways, no one wants to talk about stablecoin. They're like, we're here to talk about something else, and it is not the question of exactly how we're going to have digital assets. That said, you made a really interesting point about the role that technology plays in financial stability and how it could actually expedite or hasten crises stemming from monetary policy accidents or fiscal policy accidents. Can you talk a little about that?
Well, what we know is that financial innovation is good, but it increases risks. It accelerates impact. And if this impact is positive, great. If it is negative, it can lead to spillover impacts within an economy and even across its borders. My message on this point is, don't live with the illusion that technology is going to make your life simpler. It won't. You need strong policy frameworks, even more so in a world of fast impact from technology. More, not less.
I'm smiling because I don't think anyone feels like artificial intelligence has really made their lives that much more easy, that much easier. Everyone's just trying to scramble to keep up with everything. Do you think right now that the potential issue that could cause some sort of systemic event really is inflation, and potentially inflation getting a bit out of control and forcing the hand of central banks more aggressively?
So the good news is that inflation expectations are still well anchored. We have had stubborn inflation, and it is something that central banks ought to pay attention to and take action if necessary. And it was very reassuring to hear Chair Warsh saying that if necessary, we act. But we are not seeing the underlying trend to be one that creates fears that inflation is getting completely out of whack. It is not happening. Why is it important to act decisively early? Because if inflation expectations were to de-anchor, then what would happen in markets is, of course, nervousness turning into panic. We don't want that to happen.
Do you think that there is a credibility issue for central banks in developed markets right now, given the concerns with the fiscal overhang and given some of the fears that they've been reluctant to address inflation, just trying to explain it away, trying to figure out what exactly they're dealing with?
They need to be laser focused on trust in their ability to contain inflation. And in that sense, the message to central banks is, if you need to act, do not hesitate. Hesitation creates concerns. But let's be fair to central banks. They have sustained independence in decision-making. They do act on the basis of information. And if you look at the U.S. economy, growth is strong, unemployment low, productivity is amazing, 2.5% growth year after year. So the real economy is doing well. It is inflation that is the headache.
So something that you've noted, and other people have too, is that everyone's been surprised at how resilient the global economy has been in the face of higher oil prices in particular. That's one big aspect that's been a surprise, not to mention the underlying economy as well. Do you expect that to keep going? Do you think that that resilience is well-founded, or do you think that it's fragile and bifurcated in a way that gives you pause?
The right way to answer is, so far, the world economy has been resilient. This resilience cannot be taken for granted. Why it has been so resilient? Because of these two forces, AI boosting it up, and not as strong impact of energy prices as we feared. There was talk about energy, oil prices, $100, $150. That did not happen. The question is why? It didn't happen because reserves have been deployed, because other sources of energy, including the United States, stepped up, because shift to alternative energy is quite profound, and also because we are more sensitive to price than we thought we would be. So demand went down. Now, out of these reasons, supplies, reserves, this is not forever. And if we see energy prices climbing up, they would complicate the inflation story. And that is something that, of course, we are concerned about.
Do you think that there's any risk that the dollar truly could be undermining, that the dollar could be undermined as the reserve currency? Do you see any signs of that, or do you think that that's been shaken, that's been sort of put to rest?
What is the alternative? When you look at what is happening, and that was actually the subject of this symposium, where is financial innovation taking us? Stable coins. Who is backing stable coins? The United States. 98% of stable coins come from here. They originate from here. How is that being done? With treasuries backing stable coins. So there is no clear march towards an alternative. And let me say something that I wish people would pay more attention to. What is the strength of the dollar? It is the strength of the U.S. economy. And the U.S. economy, with deep and liquid capital markets, a lot of investment in venture capital, in innovation, attractiveness, other people's money come here. They don't go somewhere else. All of this underpins the strength of the dollar. This being said, we would still be advocating for responsible fiscal policy here in the United States and elsewhere.
Managing Director Kristalina Georgieva, thank you so much for spending all this time with us. Really appreciate it. That was Kristalina Georgieva, the Managing Director of the IMF. And Romain, I will send it back to you.
All right, our thanks there to Lisa, who's been doing a lot of great work out there in Jackson Hole, Wyoming. Meanwhile, here in Studio 2 in New York, we keep the conversation going. And let's bring in, right now, former FDIC chair and senior fellow at the Center for Financial Stability, Sheila Bair. Hey, Sheila, I think the last time we spoke, believe it or not, I think it was the last time there was a first Fed chair meeting, Fed Warsh meeting.
That's right. Yeah.
Back in June. And I remember you gave him an A+ for handling that press conference. Did you get a chance to listen to the speech? And if so, how did you grade it today?
I did. Well, I'll give it an A.
Okay.
There were a couple things I was disappointed. I know it's touchy, and I'm not surprised he didn't. But I was hoping he'd bring up the national debt as an inflationary, a factor in trying to figure out what's going on with inflation. But overall, he did what he needed to do. There's a lot of substance. Talked about the economy, shared his personal perspectives. Again, explained the last meeting decision to hold. So and it tweaked a bit on the hawkish side, but he was suitably general. Will take action, didn't say what they were going to do or that they would take action. He wants convincing evidence that meaningful evidence, I think he said, that inflation is coming down. The big question is what the trends are. And I think that's refreshing. I mean, I think the Fed, obviously, hindsight's always 20/20, but they were a little too eager to see cooling inflation and started cutting too early, and we had a problem. So I think wanting to see clear evidence of trends and acting based on that is good. And my guess is the trends are not going to be good. He's going to be raising rates, if not in September, October.
Well, I know he didn't want to tip his hand and obviously say that. No Fed chair does. But he was sort of giving himself a little bit of wiggle room to maybe get out of that should, I guess things change. But I just want to be clear, too, because as he talked about this persistent inflation, acknowledging it head on, he also talked about how, in his view, he didn't think broad financial conditions are restrictive. He talked about how real consumer spending, despite all these shocks, is still increasing. basically he painted a picture of a relatively healthy economy. And to kind of build off something that Kristalina Georgieva was saying is like, you know, you're supposed to fix your roof when the sun is shining, not when it's raining. So if you have a healthy economy and you know inflation's running hot, as it has been for 65 straight months, why not do something now?
Yeah. Well, I think that's right. And I think that's eventually, again, unless the numbers show us something differently, in my glasses, that's where they're going to end up, and they should. And there is, you know, financial conditions are certainly not restrictive. In many sectors, they're pretty darn loose. And I'm always scratching my head about why they're cutting bank capital requirements to get trillions of more new lending supposedly into the economy, which would also be inflationary. And that's been a long-term frustration of mine, that the Fed doesn't really look at the supervisory side, the regulatory side of what they do. But yeah, he has room to tighten without hurting the economy. And you're right. That's when you want to do it, when you've got the flexibility and bandwidth to do it.
Well, let me ask you about the banks and their ability to withstand any sort of interest rate hike cycle here. I mean, we're coming off one of the most profitable quarters that we've seen for banks in a while, at least the larger banks, I should point out. I mean, do you see the banking system as strong, and particularly strong enough to withstand, if it does get there, a meaningful fight against inflation with regards to rates?
Yeah, no, I think well, again, we're weakening capital standards and the liquidity rules, but I think they're fine. I mean, higher rates in many ways, parts of their business helps them. It doesn't hurt them. So they have longer term securities that have lower yields. Those lose market value. That was the problem that the regional banks got into in 23. I don't see that kind of rapid hike taking place. I may be wrong. But no, I think the banks, I would not worry about banks in a rising interest rate environment. I would worry about banks in a stagflation environment where the Fed is having to raise rates at the same time we're seeing an economy slow and loan losses go up, unemployment go up. That would create a real problem. But hopefully he can avoid that. And again, but it's another reason why, you know, probably no time like the present if the data continues to show rising inflation or even a trajectory that's not as quick as it should be. I think it's at due speed or whatever. It's time to hike.
But with some of like the mid-sized banks, I mean, have we sort of resolved or at least addressed to a certain extent some of the duration risk that was out there that kind of took down Silicon Bank, Valley Bank a couple of years ago? I mean, because that's still a concern. And I should point out, for all the profits that these banks reported, I mean, they're still sitting on, you know, hundreds of $billions of unrealized losses that are going to have to be reconciled at some point.
Yeah, well, that's true, and they are going to be strengthening the capital treatment of those unrealized losses in a way that I think long term will be helpful. No, I think because, you know, banks do not have to mark to market. They have flexibilities that other companies would not have on this. So I think they will weather it. There is a lot more. I think the 23 kerfuffle with the regional banks, I think, really woke up bank managers and woke up examiners too. And a lot of scrutiny on those unrealized losses, a lot of, you know, behind the scenes supervisory actions to make sure they can withstand losses. Depending on what happens with interest rates, strengthening interest rate risk management could do better. But I think, you know, that's these mini crises sometimes have positive impacts in terms they wake people up and, okay, we need to get on this. This is the problem. We need to get it fixed. And I think that's what happened after 23.
Well, I mean, our regulators kind of forgetting, though, the lessons of 08. You keep mentioning the idea of these lower capital requirements that the banks have been pushing for. I mean, obviously, their argument is, look, I mean, we're pumping money, we're lending more money into the system if you allow us to do this. I mean, is there a balance to that argument?
Yeah, well, why do we want more lending? There's not a shortage of credit. And, you know, you get them all this additional balance sheet capacity. First of all, they'll probably just do buybacks, right? They'll probably do shareholder distributions, not only loans. But assuming they do, they've got to go off and find borrowers. And they're going to be riskier borrowers because pretty much anybody who deserves a loan now is getting one. So I don't, that's inflationary. Again, I think deficits are inflationary. There is so much going on, frankly, that's beyond the control of the Fed that's creating inflationary pressures, which is why I'm not optimistic he's going to see a downward trajectory on inflation. But no, there's not. There's plenty of credit out there already. They're making plenty of loans. They don't need more capital capacity to do so.
But with regards to the Fed's focus, or maybe lack thereof, on some of the regulatory stuff, I do have to ask you. I mean, everyone, I just say everyone, but a lot of people, they hate the dot plot. But I think the only thing they hate more than the dot plot are these stress tests. And I am curious about whether these. I don't know. They force us to cover it, and I don't think I've ever learned anything.
No, I hate them too.
But you know more about this, and I mean, I don't mean to be glib, but I mean, do these stress tests, the Fed stress tests, tell us anything useful about the shape these banks are in?
No.
Oh,
no,
okay.
I wrote a piece for this for FT a while back. No, I think they need to be. You need to have some type of stress testing process to make sure that banks are prepared to withstand and are resilient enough to withstand shocks. But the nature of those shocks, those risks changes. It's got to be a dynamic process. And they just keep stressing a 2008 type of scenario. And they've never stressed a stagflation scenario. And there's so many other risks out there that they really need to be focused on. And so it's not only it's a huge distraction for the supervisors, for the bank management. It creates a false sense of security. They always pass now, and everything must be fine. I think Jamie Dimon had a telling comment that it actually inhibits bank boards from challenging risk managers at banks because, well, the Fed says we're great. Did you see our stress test results? Mm-hmm. Well, maybe they aren't. So they need to go. We need to be replaced with a dynamic process, less public, not tied to capital, and which makes it inherently contentious. And so I think my guess is Warsh will be dealing with that. They will be making some significant changes.
All right, Sheila, always a pleasure. I really appreciate it. Have a wonderful weekend. Former FDIC Chair Sheila Bair, and of course, if you haven't read her memoir back from 2012, The Bull by the Horns, definitely go check it out. We're going to set you up for what to watch over the next week. Stick with us. This is Bloomberg. Just a programming note, the close will be on the road. Next Monday, we'll be broadcasting live from T. Rowe Price's headquarters in Baltimore, Maryland. We're going to catch up with the co-head of global investments, their CIO, their head economist there, as well as the big dog himself, Rob Sharps, the CEO of T. Rowe Price. A lot more going on, including some manufacturing data out of the Dallas Fed, keeping an eye for Anthropic's S1, earnings from Palo Alto, Dell, and Broadcom, just to name a few. Don't forget, John Ternus's first day as Apple CEO actually taking place as well. And then Friday, a big day. Once again, macro in focus, and the Fed too, with that monthly U.S. jobs report, the second part of the Fed's dual mandate. Appreciate you joining us here on The Close. Catch us on Monday at T. Rowe Price.